We're actually quite pleased with the result, particularly when you take a look at our business in the U.S. We've continued to deliver double-digit retail sales growth in the U.S., 31 consecutive quarters of positive same-store sales, and a 5.6 for the quarter we were very happy with. Disappointed in the international comp. It was our 100th consecutive quarter of positive comps, but at 2.4%, a little lower than what we're used to. That said, the retail sales growth still very strong at, accounting for foreign currency, almost 9% for the quarter.
I'd love to dig a bit more into the U.S. comp number. As you mentioned, up 5.6%, a bit shy of analysts' expectations, but driven by traffic, something that you really talked about quite a bit on the phone. Does that lower than expected number signal consumer slowdown in the U.S.? Is it a result of the fortressing strategy that I mentioned in the intro, opening up more stores, or were analysts just overly optimistic?
Yeah, there is, from the fortressing strategy, we do have, as we mentioned in our Investor Day in January, about a point to a point and a half of headwind on the comp because we are carving up our territories to get closer to our customers. And that's an investment we're more than willing to make because it drives retail sales growth and transaction growth in the long term. And that's how we're going to build our business in a healthy way over the long term.
Can I ask you about not pizza per se, but just the business of dividends and share buybacks these days? Do you pay attention to some of the proposals that we're hearing on the campaign, early campaign trail? Rubio's out there saying he might tax buybacks as implied income, basically. Others are floating things around that would make it costlier to do dividends, bring that rate back up to ordinary income. As a company, how do you make these choices the most efficient way?
Well, we're committed over the long term to returning cash to our shareholders. And if you look 2011 through 2018, we returned $3.5 billion worth of cash to our shareholders through buybacks, through ordinary dividends, through special dividends.
And what would have happened to that $3.5 billion if you didn't do that?
Well,
I know it's hard to say that it might, but some people say, are you going to pay your workers more? Are you going to invest more, or does that just sit in the bank?
Well, we'll talk about 2018, for example. So 2018, our capital spending was up $30 million over where we were in 17. So we built a supply chain center right here in New Jersey. We've got 2 more projects underway, one in South Carolina and one in Texas. We raised wages in our supply chain centers across the country. And we opened up in the U.S., another 258 stores, with about a dozen of those are corporate stores. So we're investing in the business and continuing to invest in technology. That's always the first line for our cash, is what can we do to invest in our business? And then from there, we believe our responsibility is to return cash to our shareholders.
Mm-hmm. From phone call to delivery, what's the average delivery time? Or app use to deliver?
Sure. So we're better than we've ever been, in the business, and we run in the neighborhood usually of about 25, 26 minutes on average, with some of our top performing franchisees who have fortressed their markets running below 20 minutes on average.
Wow.
How many franchises does the typical franchisee own?
So the average franchisee owns about 7 stores, just shy of 7.
Wow.
And in 2018, the average franchisee cash flowed well in excess of $900,000 across those 7 stores, about $137,000 to $140,000 in EBITDA per unit.
I'd love to ask a question on labor and technology. Obviously, Domino's has long been the leader with consumer technology, ordering on the app, getting it to you quickly. But labor costs are there, no matter what your business model is within this part of the economy. I mean, is there any plans to kind of turn that technology around and use it on the back end of the business to cut your labor costs?
So we're working on things in our stores to make the business more efficient. Mm-hmm. Because as you said, Kate, not only is labor more expensive, but also the market is just so tight right now at 4% or lower on unemployment. So that's part of what we're doing, is investing in technology. We launched an inventory app just this past year, voice activated, so our store managers can walk through the cooler at the end of the evening and just say what's in the cooler and update their inventory.
Wow.
Takes a significant amount of time off of that task. And beyond that, for the long term, what's going to take our labor costs down is going to be fortressing our markets and shortening the delivery radius from our stores. So if we've got to drive 9 minutes out and 9 minutes back to deliver a pizza, there's a significant cost to that. When it's 4 and 5 minutes, it's a dramatic change in labor cost.
Gosh, it smells good here right now.
Sure does, doesn't it?
It really does.
You want what is that, sausage and peppers over there?
Peppers.
All right.
All
right.
Yeah.
Bring it right on over.
Bring it over here.
There you go.
Tyler, this is not a personal pizza. This is a Tyler
Oh my, that's
pizza.
That's good.
That looks fantastic.
That looks fantastic. I'd say.